of Australia's biggest landlords are grappling with a slew of challenges in their property portfolios. Just look at some of the results coming through this reporting season so far. Property revaluations in this interest rate environment. But there are portions of these property portfolios that are doing very well, even in a rising interest rate environment. So if we take a step back and think about investors like you and I, how should commercial property fit into a strategy? Does it fit into a strategy? What type of commercial property fits into an investor's strategy? Anthony Landahl from Equilibria Finance joins me to hopefully help answer those questions at least, because it is a sector, generally speaking, that has been hurt by rising interest rates, but pockets remain very strong. So how do you read the landscape?
Yeah, traditionally, for a more mature investor, I guess, who's got a number of residential properties, commercial properties tended to provide some diversification. Historically, it's offered returns of around 7 and 8%. It offers capital growth, and often for a business owner, it offers their premises, and rentals are often also tied to inflation. So it's been quite an attractive proposition. As you noted there, it is facing some headwinds at the moment, particularly the office space and the retail space. We've got rising costs of funds, we've got rising costs of construction, and we've got a lot of uncertainty around tenancy and potentially a structural shift in office in the office landscape. So that's where they're facing the headwinds, and I think there's been some recent data in reporting season around the challenges some of the property trusts are facing with that traditional office space. So I guess flip side is where they're seeing a lot of opportunities is around logistics, warehousing, and that type of third party commercial property where there's been a lot of demand, and that's a structural shift as well through COVID, with a lot more movement of goods around, which is currently quite an attractive part of the commercial office, the commercial market.
I think let's just take a step back, because you said mature investors and you said, people who already have a residential property portfolio. Are you talking sophisticated investors? Are you also saying you wouldn't want to jump into commercial property unless you already have an investment?
It's a much different mindset, commercial property. You're looking at a longer term time frame. You're looking at understanding the valuations of the property. You're looking at understanding the terms around rental leases. The financing is often different around how that's structured. So firstly, it's a different mindset going into commercial property. It does add that diversification, and also historically it's given returns of 7 or 8%, whereas maybe a residential portfolio might be 3 or 4%. So I think it's the type of thing where, when I say a more sophisticated investor, you're looking at an investor who's probably looking at diversification, who takes the time to understand the market and the sort of area they want to go into. The commercial market covers pubs, it covers office, it covers retail, it covers warehousing and industrial. And for an owner-occupier, it's a slightly different proposition. So it's really educating yourself around the commercial terms. A lot of finance, for example, is bound by lease terms. So it's really understanding potential capital growth, but also the cash flow and the potential yields through that time. It tends to be a longer term sort of hold. A lot of commercial property investors at the moment are trying to hold on to their properties through this time where, as you intimated at, valuations are being challenged. In fact, a lot of valuations for office space are being written down at the moment. So it's a tricky environment for those investors, but the longer term investors tend to be able to hold those properties through those downswings and as the market picks up again.
Okay, so that is giving us an idea of who should potentially be considering commercial property. What types of structured vehicles can be used, are in use, would you recommend to use for commercial property?
What we tend to see and what tends to happen is not a lot of people looking into commercial property would go direct. If you're a residential purchaser, you might put it in your own names, for example. Commercial properties, the main considerations are asset protection. For example, if you're running your business out of there, you might have intergenerational transfer where you're looking at an effective way of transitioning a property to, and a tax effective way of transitioning a property through to the next generation, and tax effective structures. So it often tends to be in a family trust or a unit trust set up. Self-managed super fund has become a vehicle that's been used for investing in commercial property as well. So they're the sort of vehicles we're seeing people use. Secondary to that, it's how people access it. So you can directly invest, or you can go and use property trusts, which are quite common, either listed or unlisted property trusts, which give another access point to actually get into the market.
Fascinating. Okay. When you're thinking about financing, though, for commercial property, you alluded to it earlier, it's very different than it is even for residential property investing.
Yeah, if you're a first-time investor in commercial property, again, it's an education. It comes down that you might have a lower loan-to-value ratio. It comes down often to the security type. Is it a multi-purpose space you're utilising, or is it, for example, a veterinary clinic where they might actually lend less because it's going to be harder to sell ultimately or harder to rent on the way through? So there's a lot of different factors to consider around that. Often the cost of funding might be higher, the terms might be less. But on the flip side, with commercial property finance, there's often a lot more flexibility around how you can structure things. You might be able to bring in other assets to fund 100%. You might be able to get a finance around lease terms. And there's a lot more flexibility as well around if you want to develop a commercial property site and the funding of that. So there's probably more flexibility around some of the ways you can structure your finance, but it may be you need more upfront cash flow, they might be shorter terms, rates might be higher, and stuff like that as well. So it is a different environment.
How does it stack up though? Because would one be able to expect a higher yield from commercial property, generally speaking? Put aside maybe people who are buying commercial property for their own business purposes. Sure. But as an investment.
Yeah. Well, historically, I looked at some data and it's returned around 7 or 8%, which is quite solid. But at the moment, you mentioned at the top there, it's facing a lot of headwinds. The cost to fund, the cost to construct new office spaces has skyrocketed, and the uncertainty around tenancy, particularly with office space. So it's a pretty cautious outlook at the moment for people looking at actually buying in the office or the retail or the more traditional commercial space. Reporting seasons indicating that some of the property trusts are writing down assets. So that's been a challenge. So there's a bit of caution out there in terms of the office and retail space, but the flip side of that is there's quite a lot of activity around pubs, there's quite a lot of activity around the warehousing and the logistics, and they are offering good returns both in terms of the yields on the way through, getting long, good, secure leases, as well as capital growth over time. Tends to be a much longer term hold though to capture that.
And when you're having these conversations with potential investors, is this a longer sort of time frame to get into this type of opportunity?
Yeah, some of these opportunities can take years to come into fruition, particularly if it's a development, a greenfield site, or even if it's somebody looking at getting into the market, negotiating with existing terms, understanding tenancy if you're looking at buying an office block. It's a much longer transaction. It can take 6, 12, 18 months, 2 to 3 years sometimes as well. So patience won't cost you money, Bart Cummings sense, and that's one said, and that's very true in terms of your commercial property market.